Today, we're going to look at why some valuations are completely wrong and why having a massive valuation can actually be the worst thing to happen to a young company. To understand how valuations can be wrong, you have to understand how they are calculated. If a public company, say Apple, is valued at $3 trillion, for instance, it is based off of 1 million trades happening on the public market every day. It is liquid, it is real. But startup valuations, not so much. They rely on something called post-money valuation. So what is post-money valuation? Let's say you and your co-founder own 9 million shares of a company. An investor comes along and then buys 1 million new shares for $10 million. That means each share is now worth $10. Because there are 10 million shares now, the total math says that your company is now worth $100 million. But wait, nobody actually paid you $100 million for your company. Someone paid $10 million for 10% of it. The other 90% is illiquid. You cannot just go and sell it tomorrow. And it gets even more interesting when you factor in the fine print. So, what is in the fine print? When VCs invest in a startup, they're not buying the exact same shares that the founders have. They're buying something called preferred shares. Preferred shares come with a superpower called liquidation preference. This basically means that if the company goes bankrupt or sells for less than expected, the investor gets their money back before the founder or the employee gets even a dime. Let's say a VC values a startup at $1 billion to win the deal, but they write in a 2x liquidation preference. This means that if the company sells, the VC gets double their money back off the top. When VCs invest money in startups, they expect that out of 10 startups they invest in, 9 of them are going to fail, but they expect one to be a mega winner who is going to pay for all the losses. And this is why when there is one startup that looks like a potential winner, every VC wants to get involved, every VC wants in. So this fear of missing out creates an artificial bidding war where the valuation stops being about the revenue or the product, but simply about how much money the VCs are willing to put into a company. So you might be thinking, who cares if the valuation is not worth its salt? The founder still gets to be a billionaire on paper, right? Well, actually, a hyper-inflated valuation can actually be a death sentence for a startup. If you raise money at a $1 billion valuation, now you have to build a business that can go public at $3 billion or $5 billion so you can give your investors a return on their investments. If you miss your growth target, you have to raise the next round of funding at a lower valuation. And this crushes employee morale, destroys your cap table, and even signals to the market that you're failing. So valuation is not validation, it's a bar you have to jump over. So the next time you see a headline celebrating a startup's massive valuation, take it with a pinch of salt. Remember, it's most likely driven by FOMO than by cold hard cash flow. If you liked this video, make sure to hit subscribe and let me know in the comments, which company do you think is the most overvalued in the world right now? I'll see you in the next one.